Tax is typically a big focal point for any real estate investment. This is simply because if there are unexpected tax liabilities, this reduces the return to the investors who are coming into the structure in the first place. So tax is obviously a key focal point for any form of real estate investment. So what are the key tax considerations we're talking about? Well, from a UK perspective, let's look at that for a moment, and broadly similar rules will apply across the rest of Europe. The first thing we look at is income arising from the investment. Now, if we're talking about using a corporate vehicle as the investing vehicle, any income will arise into the hands of the corporate vehicle and will be taxed to corporation tax in its hands, currently at the rate of 19%, but reducing to 17% next year. If we're talking about using a flow-through structure, such as a joint venture with using a partnership or a contractual joint venture, then that income would arise directly into the hands of the investors and be taxed at their rates, and if individuals, at rates of up to 45%. Other considerations that come to bear are acquiring the investment in the first place, acquiring the real estate. Typically there, we're looking at stamp duty land tax if we're buying the asset, and possibly also VAT. But we may be looking at buying a corporate which holds the real estate, in which case, if it's a UK company, we'd be talking about 0.5% stamp duty on the acquisition of the shares of that company. On an exit, we'd be looking at either selling the real estate asset itself, in which case the purchaser would be looking at paying SDLT and possibly VAT, or we might be selling the shares of the corporate owning the real estate, in which case the purchaser would be looking at paying stamp duty at 0.5%. Other taxes, capital gains tax on an exit, that's an important consideration. If the owner of the real estate which is making the disposal is the corporate, that capital gains tax would be taxed at up to 19%, being the corporation tax rate going down to 17%. But if we're talking about a flow-through structure, it would be taxed at the marginal rates of the individuals behind the structure, and possibly at up to 28%. The future of European real estate investment is a little bit uncertain. This is largely because European governments have woken up to the fact that European real estate is a stable asset class, and therefore investors from perhaps less stable parts of the world are looking to diversify their risk by investing in European real estate. This means that where there's an appetite for real estate, taxes will naturally follow. Now, it used to be the case that if you invested in UK real estate, for example, you could do this through a corporate structure as an overseas investor and exit with a minimum of taxes to pay. These rules have been stopped. There's now what we call an indirect capital gains tax charge that's being imposed. So any foreigner coming in and holding UK real estate, either directly or through a chain of companies, would expect to pay some capital gains tax on an exit. Similar rules are being introduced across Europe. One thing to bear in mind is that any real estate investment structure which historically was thought to be fit for purpose for perhaps a 10 to 15 year cycle, that situation is no longer the case. The changing tax landscape and the pace at which tax rules are being introduced means that any particular structure, whether it's a corporate joint venture, a contractual joint venture, or a partnership, will need to be looked at on a 3 to 5 year cycle to ensure that it's fit for purpose and is keeping abreast with the changing landscape in which it operates.